Vanakkam, Namaskar, and hello to all the viewers and listeners of this episode of Fixed Income Markets with Sundaram Mutual Fund. The month saw the unveiling of the monetary policy, which delivered the consensus hold of repo at 6.5% with a 5-1 majority. Professor Rama voted for a 25 basis point cut. The stance was maintained at the withdrawal of accommodation, again with 5 to 1 vote. Professor Verma was the one who dissented. Governor maintained last mile of disinflation is the most difficult one and vowed to bring down the inflation back to the 4% median mark on a durable basis. Minutes of MPC revealed that external members were worried about the real rates hurting growth. One of the members argued for keeping liquidity in the system such that the overnight rate is aligned to the repo rate, while RBI members seemed cautious in approaching the rate cuts or stance change on account of robust high frequency indicators and sticky food inflation, particularly with monsoon outlook unclear at this juncture. CPI numbers were lower at 5.1% compared to the last month, but slightly higher than the expectations. Silver lining was the continued fall in core inflation momentum, coming at 3.6% versus 3.8%. No surprise is there on the supply side, then the benign base should push the headline towards or below 4% target, aligning with the core. Household consumption survey indicated a narrowing of consumption pattern between the rural and urban consumer, with expenditure on food items moving down from the current weight of 46% in the CPI to 42%. The aspirational spends have been increasing both in rural and urban India as monthly per capita expenditure rises. In due course, as more data becomes available on consumption expenditure, weights in the CPI might be rebalanced. GDP for Q3 FY24 came at 8.4%, beating the consensus estimates by a wide margin of 1.8%, while the GVA came at 6.5%, more in line with estimates, which meant that growth in taxes drove the GDP. Investments drove the GDP while consumption took a backseat. However, the pace of growth was enviable considering the tepid global environment. Globally, US CPI inflation was marginally higher at 3.1% versus 3% expectation, while core was 3.9%, a more preferred gauge of FOMC personal consumption expenditure was at 2.4%, while core was at 2.8%. Second estimate of Q4 GDP came slightly lower at 3.1%, with deflator also slightly higher at 1.6%. Overall, the US economy continues to show resilience on face of high real rates, largely driven by the government's printing and sticky wages compensating for the loss of purchasing power. It will be interesting to see that with debt limits once again in question, the spending permission need to be obtained from a bipartisan Senate will decide the outlook both on shutdown and growth. FOMC members reiterated that the cuts will be delivered as per the incoming data and any immediate cuts can be ruled out. Markets are pricing a high probability of a rate cut move in June policy. European Central Bank has cautioned an early rate cut may not be in the best interest for Eurozone as inflation has been sticky despite recession in its largest economy, Germany. In effect, the members of ECB don't want to move before the FOMC does. This is the story in most nations fearing a currency move from an early rate move. China cuts its 5-year medium-term lending rate by 25 basis points from 4.2% to 3.9% to lower the mortgage costs to revive the consumer sentiment along with host of liquidity measures to drive the economy to sustained recovery and help the beleaguered sectors. We believe that this is a work in progress and will take time to work its way in the economy. However, the direction looks right. In general, we should see the next move being a rate cut in most nations as the central banks figure out the opportune moment to cut rates anchored around the move of Federal Reserve. In India, the robust tax collections can make the long bonds attractive as government looks to achieve the lower revised fiscal deficit target and add the tailwind of index inclusion which will kick in from end June 2024. Government keenly looking to crowd in the private sector to make growth more equitable. From a liquidity perspective, the Reserve Bank of India is likely to modulate liquidity depending on the cash balances of government with RBI and their stance of withdrawal of accommodation. In general, the repo rate should trade somewhere between repo rate and marginal standing facility rate. As we enter the final month of quarter, on account of advanced tax outflows and rise in currency in circulation on general elections, liquidity tightness can continue in the month of April as government spending may get delayed on elections barring regular spending of wages, pensions, subsidies, etc. Ones who can time the market to take exposure to longer duration funds, namely gilt funds, long duration funds, etc. We at Sundaram right now do not have these products. For all other investors, we recommend for investors with particularly 18 to 24 month horizon to remain deployed in mid-duration funds, namely short-term funds, corporate bond fund, banking and PSU fund, etc. While for cash management, the investors can continue to use overnight, liquid and ultra short-term funds. We will also like to caution the investors that once the first rate cut get delivered, most of the cycle will get priced in by the markets as per their estimate of the final delivery of the repo rate. Thank you and see you in the next episode.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.